Markets were very, very strong in FY21. We had obviously COVID hit the world in the early part of the calendar year of 2020, and the market fell, recovered, and then over the past year has risen very strongly as people have got excited about vaccines and the reopening of the economies after a big downturn for a few months, for the first half of calendar year 20. The world index was up 28%, and of note, this was really led by the US and particularly the technology sector in the US, rising, depending on the index, around 40%, which is an extremely strong year. Well, the Australian market was up 28, and our main Australian share fund lagged that benchmark, returning 22%, which obviously is a good return. But it is the tendency of a defensive manager to lag a very strong market, and that's what happened to us last year. So we lagged the market, but we're not that far behind, still delivering a good return overall. Well, the market was driven a lot by consumer discretionary stocks, that sort of things like retailers and so on, that were hit a lot in the COVID lockdowns at the beginning of 2020. Financials did very well as interest rates at zero seem to have fanned a lot of deal making and so forth. And resources have been very strong commodity prices. This didn't really replicate our portfolio, which is much more defensive, with laggard sectors being things like healthcare, utilities, and consumer staples. For the fund, key performers were things like Virgin Money, UK, which did very well, along with most other financials. Incredibly, CBA, for example, was up 48% for the year. Other good contributors were Tabcorp, which has received some interest for its wagering division, and the lotteries division has continued to perform very, very strongly. Also of note were News Corp and Nine Entertainment, which have performed very well, both of them with a variety of different media offerings that have done well. And I always love to say, how Nine has gone to a very digital offer with things like Stan, Nine Now, where you can watch the famous Love Island, and so forth. Holding the portfolios back were things like the banks. The iron ore stocks were very strong with the commodity stocks. And some of our core holdings, we did poorly, either falling or being flat, things like CSL, Horizon, Insurance Australia Group. But these are things that we actually have a lot of confidence in going forward. Because they have lagged, we're actually more confident about our portfolio than we have been for some time. We are positioned quite defensively. The markets have been running on a lot of speculation. You've had speculation in things like cryptocurrencies, electric vehicles, Tesla, and things like that. And companies that have never made money have very large valuations. And what's been left behind in all the speculation has been some really solid companies, as I've already alluded to, things like Horizon, CSL, Orica, Insurance Australia Group, core holdings for us that we think will outperform any downturn, if there is a downturn, from these very heady levels, or will be appreciated by investors as they continue to deliver good results. A company like Horizon has not really had any meaningful interruption to its business, and yet the share price has done poorly. And then you've got other companies that haven't yet earned any money at all that are valued very highly. So we have a lot of confidence in our portfolio doing better than the market in the medium term.